The fourth seminar we put on during our 40th anniversary is called Loans, Who Has the Money and How to Get It. Excellent workshop. And use this workshop, by the way, to find out exactly what process you have to go through to get the money that's out there for your small business.
A little pitch for SCORE right here. You've heard us talk about SCORE. You've seen our counselors that are out in the foyer and walking around. We have people that will help you. Will help you actually with your marketing plans, your financial forecasting, ultimately resulting in we hope, a very good business plan, and maybe even some documents that you'll be able to use to submit to a bank or a lender of some kind. So I highly recommend that you sign up for one of our counselors. There's actually a sign-up sheet actually in your folder if you want to actually sign up. As been mentioned probably many times before, SCORE provides free, I said free, counseling, mentoring for any kind of business. We have 42 very experienced people who are actually here to help you. And then we also offer online and in-person low-cost workshops that we do on Saturday mornings. And those workshops are almost like taking an MBA course in like about 7-8 weekends. They're low cost, and I think you'll really enjoy them. So what are the sources of capital? Certainly, the best source of capital to kind of start a business of any kind is your own. If in some way you can have enough savings or can get to cash enough to be able to either finance your business or used as collateral for your business, that goes a long, long, long way. If you can't use your own personal savings, then there's family and friends. That's usually the second line of defense, where you can ask your friends and family to basically either loan you money or give you money or be partners in your business. Of course, the bad part about that is you really need to pay them back, so you have to remember that. You can take in partners, and there's a whole list of issues that you have to kind of deal with partners. You can actually look at your insurance policies, and sometimes you have cash values and insurance policies to get money. And of course, once you have an existing business, you have something that I call the engine, which basically is your business is basically creating enough money to sustain you and grow you, or have retained earnings for whatever you want to do in the future with your business. And then there's the debt side of money. And the debt side is the side that we're going to basically spend more time talking about this morning or this afternoon. There's banks, credit unions that can basically give you loans. There's SBA guaranteed loans, which we're going to spend a little time talking about today, what they are, what different kinds they are, and how to get them. There's outside investors. You can always go out and try to find a partner or someone that is a venture capitalist or someone that can basically give you some money on the outside, and he's going to want some equity. He's going to want some interest in your business, to do that. And there's something called angels. Just kind of curious, I was talking to one of our presenters today of how many people know what an angel is? And I'm not talking about the ones from heaven, I mean, even though I think most of them are. Well, that's good. I think you'll get to know. So let me just, without further ado, kind of introduce some of the people. We have Eric Mendel, who is a vice president and commercial loan officer for Wells Fargo. We have Aaron Lorenzo, who is the district manager for the Small Business Administration. We have David Sabatra, who's a vice president of, senior vice president of First California Bank. And we have Bill Barber, who is a president of a company that is actually an angel group called Maverick Angels. And my name is Bill Gutneck, and I'll be the moderator, today. So let's just kind of start. And the first thing that's on my mind, at least, is SBA loans. Here are some of the questions that I kind of put together for SBA loans. Now, this is going to be an exercise because we only have one mic, so I'm going to lose about 5 pounds in this, I think. So.
Thanks. Hi. Whoa, that was pretty loud. Hi, my name is Ian, and can I see the hands of the people that I've already spoken with today? Okay, so a fair number of you. For those that I haven't spoken with, first thing I want to do, and for those that I have spoken with, is correct, if it's okay, Bill, on something really quickly. And I appreciate the promotion but I would hate for it to get back to the actual district director. I am not the district director for the SBA. I am a business development specialist. Misnomer, it should be business development generalist, because what I do is I kind of have a little bit of knowledge about a lot of the programs that the SBA does. And we have other people that specialize and get more into depth in their particular fields. But anyhow, one thing that I do know a bit about is SBA financing and the different types of loan products that the SBA offers. I think what I'll do is I'll use Bill's slide here and go down the list. The different types of SBA loans. Okay, how's getting an SBA loan a little different than a regular bank loan? Well, simply put, an SBA loan is a commercial loan, which means that you will be going to a commercial lender, such as our friends here, Wells Fargo. You might have met Art from Chase, Bank of America, U.S. Bank, any other lender that is a participating lender in the SBA loan program. You will be going to them for your loan application. That's where you submit the loan application. Different types of loans. The 7A loan, I'll skip the microloan for just a second. The 7A loan is the SBA's umbrella loan program. That's the one that many of our loans fall under. That is the loan that people use to start businesses and grow businesses, expansion, hiring, working capital, buying supplies, buying equipment. Typically it will fall under the SBA 7A loan program. It goes from tens of thousands all the way up to $5 million. It's been recently expanded due to the American Recovery and Reinvestment Act. So now it does go up to $5 million. Let's see. We do have the Patriot Express loan program, which is marketed and directed towards active duty and veterans, as well as the spouses thereof and the family and surviving spouses of veterans. And that particular loan program does come with a little bit quicker processing, a little less paperwork, and a little better terms for the veterans. So they're welcome to ask for that particular loan product. My suggestion is always walk into the lender, and if it is an SBA-backed loan that you're looking for, keep it as general as you can. Walk in there, apply for the loan, suggest that you would like to apply for an SBA loan, and let the lender kind of walk you through the different programs that are going to be applicable to what you're looking for, as opposed to walking in specifically asking for only that type of loan. The SBA 504 loan is the loan that is typically used for real estate and large fixed equipment purchases. So if you own a printing company and you have a large press that isn't being moved very often, or if you have some sort of a machine shop and you have a mill or a CNC machine that doesn't get moved very often, basically if it's bolted to the ground, typically that's considered fixed machinery. That can fall under the 504 loan, which is also good for developing parcels of land for business use. That's going to fall under the 504 loan. Export working capital loan is for those that are interested in making products and exporting them out of the United States. That loan goes up to $2 million, and the SBA will guarantee or back the loan up to 90%. And typically the maturity is 12 months. That's a shorter term than our other loans. And if you're interested in the export working capital loan, take down this phone number and this contact. This is the person that is the expert here in the LA area. His name is Martin Sealander. And he's an expert in all sorts of international trade services that the SBA provides. Martin Sealander, S-E-L-A-N-D-E-R. Phone number is 949-660-1688. His extension is 115. And he works with the export working capital loans. Disaster loans. The SBA is the top funder in disaster recovery assistance. We do more money into the hands of people recovering from natural disasters than FEMA and the Red Cross combined. You know, the Northridge quake is a great example. The recent flooding and mudslides in San Bernardino, we put millions of dollars into the hands of people that needed it at the right time. Going back up to the microloan, the microloan is the one loan that we do that you don't need to go to a commercial lender for. We have microloan intermediaries, different lenders throughout the city, throughout the counties that do microloans. You can walk straight in to their office, submit the application. It's a short form application. Submit the application. They can review it, approve it, and fund it straight out of their office. We have about 6 or 7 locations that, that can do that. I have the information at my table if you'd like. We can get you the contact information for the micro lenders. It goes from about $1,000 all the way up to about $50,000. $50,000 is a new increased amount. It was $35,000. I believe that's what's in the notes. So up to $50,000 through the micro lenders. Now, just as Bill said, it's called the SBA Guarantee Program because it is a loan guarantee that the SBA issues. We don't loan directly to the business owners. You go through our lending partners. When they approve the loan, they send us a letter stating that and a packet. The SBA reviews it. If it falls within our guidelines, we'll send them a guarantee letter and they'll fund the loan. Basically what we've done is we've acted as, if you will, a co-signer for you. And we'll repay the lender up to a certain amount, which is the guarantee amount. And I'm sure we'll get into that a little bit more in depth here in just a second.
Thanks, Ian. I think that I should understand. Okay, my next presenter is Eric Mendel from Wells Fargo.
Thank you, Bill. I appreciate it. I will not do that again, I promise. First, I do want to, just a little side note, thank SCORE because I think they add a lot of value to small businesses. I'm glad to see the number of people here. I'm always amazed and surprised at the number of existing businesses that I talk with that really haven't had a lot of formal understanding of credit, how to apply for credit, what makes their package or financing information good, better. So do appreciate that because a lot of clients have talked with SCORE before and they offer a lot of good information. But again, Eric Mandel with Wells Fargo for 20 years in the Small Business Lending Group. And what I do is I work with businesses typically that do $1 million in annual revenues to about $20 million in revenue. It doesn't mean that we don't help clients that do business less than $1 million. We are very active in the SBA program. We've got a number of departments within Wells that help startup businesses. I personally work with existing clients, those businesses that have been around for 3 years or longer. And I lend money for real estate purchases, mainly commercial real estate, some investment real estate, but I also provide lines of credit for businesses, equipment financing, and pretty much any type of loan that a small business would need to succeed, we participate in. So do you want me to go into, because I'm more of the existing business, not necessarily the startup side of things. Okay, so I'm done. By the way, I've got a trunk full of money if anybody's interested.
He does, I saw it. The next person on our panel is Bill Barber, who is the president of a Maverick Group and investment banking group. Bill?
Thanks. Yeah, we also appreciate SCORE bringing companies up through that life cycle. Bill was right. We have a variety of different funding sources that take part in really a funding continuum for a life cycle of a company. And this is kind of where Maverick Angels play. So if you think about, really as Bill was mentioning, these different levels of funding. You've got self-funding. Anybody here self-funded their own companies? You get a show of hands there. All right, a lot of risk takers out there. That's good, entrepreneurs. And when you move to that next level, you look at the family, friends. We like to call it FF&F, right? Family, friends, and fools. He's right. You do got to pay them back. And one of the realities is they're an easy sale, but typically you've got a relationship risk that you have to consider how that would be impacted if things didn't go well. And that's an important piece of the puzzle because it impacts the next level of funding as well as the ones after that. That next level is typically the angel investment level. And I'll tell you a little bit about that in a second. From there, you really kind of move up the ladder into the venture capital world. From there, the private equity world, strategic partners, and then, of course, banking in its variety of forms, whether it's accounts receivable funding and a variety of different debt structures that are available out there. So there's an entire continuum of funding. And through a life cycle of a company, you're going to touch a lot of different ones. And that's an important thing to recognize because each one impacts the other. Okay? Some risk factors in early stage financing at the self-financing, family and friends, angel capital, venture capital levels will impact how banks will treat you later. And so it's important to recognize and consider how those impacts take place. That's an important piece of the puzzle as you're really going out to pitch your particular project for funding. So let me tell you a little bit about what angels are and really define it for you. So angels, the term an angel investor really started in back east in really in Broadway, as they were the angel or white knight investors who would come in and sweep in and save the Broadway musical and invest there. And then it kind of moved west to the West Coast for Hollywood, as it became really the funding source for movies and theater productions at that time. It eventually kind of migrated up north into the Silicon Valley, became kind of the term for early stage investors putting their individual capital into startup companies that were in the technology base, really the Silicon Valley. And now it's a ubiquitous term, not just in the US, it's international. So globally you hear the term business angels or angel investors, and that's really kind of where it comes from. Angel investor networks have evolved over the last few decades, and that's an important structural change. Angels are individuals making independent investment decisions with their own capital. Okay, that's a key distinction. It's not a fund like a venture capital fund. It's an individual investor making their own independent individual investment decisions to where they put their own money. And so an angel investor group is essentially a network or a group of those angel investors, each one, once again, making their own independent decisions, but being able to collaborate inside of a group is an incredibly powerful thing. The collaborative benefits of doing something like that is that you can share the feedback, the experience, and a really diverse historical background from a variety of different successful people who've gotten themselves into a position where they're able to fund companies. And the power of that is significantly more than the capital. Okay, one of the biggest things you'll recognize as an entrepreneur is the ability to network into the resources that you need beyond the capital to get the job done. That's a key piece of the puzzle. Investors who are looking at entrepreneurs as funding opportunities. Early stage company, yes, thank you for that ringtone, very nice. The early stage companies that we put money into are typically very transformative companies that look like they could make a significant ROI. Very different than what you kind of look at as bank debt financing with lower interest rates, the lower cost of capital money, which is really good if you can get it. But if you can't get it, you look for higher cost of capital money that's looking for a higher return. That's the angel venture capital type of model. Investors in our group are typically investors who have succeeded on their own. It's very rare that we have old money, what we consider old money in our group. It's really entrepreneurs who have successfully developed their own wealth and now are applying that back into the entrepreneurial ecosystem. So the way we kind of work this is to have those individuals come together in a group and really collaborate on the diligence, the vetting of an early stage deal for an investment decision. And then once again, each individual is making their own investment decision on where they put their money. It's a critical aspect of that. Right now, the role of angel investors is to really fill that gap in the funding continuum. It's that gap that exists between that self-funding or family and friends funding and really the larger venture capital piece. Typically, when you see companies come to angel investors, they're looking for somewhere between $250K and $2 million. That's kind of that average piece, the center of the bell curve for companies that are looking for angel capital. And angel investors may invest anywhere from $10K, $10,000 individually, up to a couple of $1 million individually, depending on their capacity to do so. But this is where it really kind of bridges that early stage company to get that momentum so that they can scale, grow, and produce their transformative product or service and get it into the market. So it's an exciting piece of the puzzle to play in. We have a very dedicated process for how we move companies through there. It really starts in an application and really moves through a series of events. And one of those events, which is a critical piece of our puzzle, is a boot camp for entrepreneurs. It's really focused on how to really understand the community that you're dealing with, the investor community, from all the way from the banking entities and the self-funding and family and friends, all the way into that venture capital and angel capital markets. It's a key piece of it. So our boot camp for entrepreneurs is a requirement for anybody coming through our system at Maverick Angels. It's a full day type of course that we put on, a 9 to 5 course that really works through both education on the entrepreneurial ecosystem as well as really how to present your company in front of banks, in front of venture capital, in front of angel capital, in front of private equity and others. So it's an exciting piece of the puzzle there. In the end, really, it's looking about how you present that message and why an investor should look at you as someone to take a financial risk on with the opportunity for greater reward. So that kind of fills in a little bit of the gap on angel funding, and we'll go from there. Thanks, Bill.
Thank you. And last but not least is David Sabridra. Did I pronounce it correctly? He's the Senior Vice President at First California Bank.
Good afternoon. I am a Senior VP with First California Bank. I'm the Corporate Banking Division. First California Bank, by its mission, is a business bank. We work very closely with SCORE. We work very closely with SBA. We're the largest locally owned bank based out of Westlake Village. We were based out of California, and we moved into Westlake because we did some acquisitions. We're a $2 billion bank. We basically look for lending amounts from $25,000 to up to $20 million. We do a lot of SBA 504 lending. That's basically my expertise. I've done probably 10 of those 504 loans in 2 years, anywhere from $250,000 to $10 million recently. The bank, by its nature, is a community bank. We talk to everyone that walks in the office. It's one of the last few places in a bank, whether it be Wells Fargo, Bank of America, Chase, or First California Bank, where you can actually get free consultation. You can come in and you can present your package to a lender, and he'll talk you through it, what you need, maybe what your pitfalls are, where to go, and what you need to do to persevere in your business. If you go to a CPA or an attorney, you're probably going to get charged about $250 an hour to get the same advice. I've been in banking 41 years. I've seen banking go from hand posting to now you can make a deposit on your cell phone, thanks to Chase Bank. So I've seen the progression, and I've been in 4 recessions, and this is probably one of the longest that I've seen in a long time. So by nature, in this point in time, and I'm sure my friends at SBA and Wells and B of A and Chase will agree with me, it's tougher to get loans because if you're running a business, it's hard to show 2 to 3 years positive income. It's just very difficult to do that because of the way the economy swings. I can tell you some of my best customers have had atrocious years 2 or 3 years ago. But by the same token, it doesn't mean that your business is going to fold. You just have to know how to restructure expenses, go forward, and maybe cut back on some of your product lines and so on. But by nature, First California Bank is a business bank. I'm located in Ventura. I handle Ventura all the way up to San Luis Obispo. Our branches go all the way to San Diego. And so you're always welcome to stop by and discuss a loan with me, and I'll be happy to talk to you. Thank you.
Do you have a big bag of money also? Yeah. Okay, well, that's our distinguished panel. I had the time to actually put together some questions that I thought everyone would be interested in hearing the answers to. So let me just give a couple of the ones that I put together first. Since there's a good portion of the people here are startups or people who are just getting their business off the ground, I thought it'd be interesting to find out for new business startup loans, where can they find a startup money? What are the different kinds of commercial loans that are available? And who is the ideal candidate for a loan? What kind of business and what type of situation? Anybody want to tackle that one? Nobody?
What was the question again? No, I'm teasing. The type of loans that are available these days, I will agree with other members of the panel when money is more difficult to get these days. I don't think I need to tell you that. I think many people here are aware of that. It's not necessarily always that banks' lending criteria has changed dramatically. It's a lot of the financial information that we're looking at. Granted, we're in the risk business. But you know, good risk or evaluating risk is an art form, and it's different things to different people. I will say that most banks are probably fairly similar in the way we approach credit. There are some differences, but you know, it's important for businesses to understand, you know, the types of loans that are out there. The lines of credit are important. It's very important to match the type of financing that you're looking for with the type of, or the need. You know, I've seen some people use lines of credit to purchase long-term assets, such as equipment and that kind of thing, and that's not necessarily the best use of the funds. So I'm going to ask you again, what was that question again? What was it? I want to make sure I cover everything.
New business startup fine loan. What kind of different loans are there, and who's an IDEC handle?
Okay, well, I think the SBA is definitely the best program for startup businesses, and I probably should let you talk about that because I'll talk more about the existing businesses.
Okay. Yeah, definitely startups, obviously most difficult to try and find the financing for. Depending on the amount, if it's under $50,000, I always suggest seeking one of our micro lenders. Over $50,000, let me give you another contact. Everyone get their pen and paper ready. This is one of our SBA financing specialists. He works for the Small Business Development Center, lead center out of Long Beach, but he does travel. He's one of the few people that travels to the clients and the businesses. His name is Jose Vega. Jose Vega, V-E-G-A. He's a lending specialist, and his cell phone number, don't tell him you got it from me, is, no, it's on his business card. He likes giving it out. 661, area code, 733-4282. And up until recently, he was a banker as well. We stole him away and recruited him to the SBA's Small Business Development Center, and he basically helps not only startups but existing businesses find the financing that they need. He helps make sure that business plans are up to snuff. He's also a small business advisor. Make sure the business plan's up to snuff, the loan proposal in general is up to snuff, all the financials look okay, and can oftentimes match the business up with the particular lender that's going to best suit their need. So definitely give Jose a call. He works with a partner by the name of Antonio. He'll connect you if you need to be connected, but for startups and existing businesses, I would suggest calling Mr. Vega.
Yeah, I think that who's the best candidate? I think the candidate that's really done their homework, analyzed the marketplace for their product, whether it be a service or a product. Because when you come to a bank or SBA, they're going to ask you, have you done some type of market search to see how viable your product is? So that's one thing. Another thing is you have to come prepared. If you want to invest in a business, that's called an amortized loan. You don't want to put it on a line of credit. Typically, lines of credit are more for matured businesses where you borrow and then maybe within, depending on the bank, 12 to 18 months, you have to take that credit line and pay it off. Some startups basically come by the bank and end up with a home, what they call an ELOC loan, a home equity loan, because that's like a 20-year product, so you can pay it off any time. But there's just two distinctions. Anytime you invest in fixed assets, that's a long-term loan. Anytime you invest in you want to put capital in the business, it's a long-term loan. Anytime you're matured and you're relying on accounts receivable, let's say you do something for Amgen and you bill them for $20,000, they're going to pay you back in 30 days. If you need that capital, you borrow on the credit line and you pay it off when you get the money from Amgen. People make mistakes, even people that I've done business with for a long period of time, is to use a line of credit for tenant improvements, buy equipment, and that's not the reason. That can really get you in trouble. So always know that when you come into a bank, typically it would be for a startup, it would be for capital. It's a long-term loan, anywhere from amortized from 5 to 7 years, and in some cases you can go 10 years. That's why the SBA program is really advantageous, because they can amortize a loan for a longer period of time, and then give you a better cash flow because your debt service is going to be lower.
Yeah, we're kind of the odd man out here because we're not a bank. We don't do debt loans, and we don't do things that kind of look like your classic debt structures, but we do debt. In the angel and venture capital world, there's a thing called convertible debt. Does anybody know convertible debt? Convertible debt notes, convertible debentures. Okay, Dennis Bays, I see your hand went up. Good, so you know. Of course, Dennis knows. The idea of a convertible debt is that it starts out as an instrument for an early stage investor, an angel or a venture capital investor, to be able to put money into a company. It starts out as debt with some typical terms associated with that debt, which might have something similar to an interest rate and some other conversion terms. And at some trigger point, that debt can convert into equity. So instead of being a loan that gets repaid out of cash, it becomes something that converts into equity in the company. And convertible debt is an interesting tool that angel and early stage venture fund investors look to because it's a simplistic style or vehicle for the investment. Doesn't fit every particular program or every particular project, but it does fit some. So companies that come to angel or venture capital investors for money, it has to be the right kind of fit for that type of capital. It's definitely more expensive than what you would look at as kind of typical or classic debt. The cost of capital is going to be higher. But when you're the right type of a fit for the right type of an ROI strategy or return on investment strategy, you can look to this type of funding for companies that are really on a fast ramp to an exciting return on investment. And that's where investors look at that entrepreneur and say, is this the right person and the right team and the right project? It's not collateralized like a typical debt structure might be with a bank, not regulated. So very different from that perspective, but in certain cases, it's a great fit.
Thanks, Bill. Before I go on to the next slide and ask the next question, just a little background about SCORE. One of the things that SCORE really excels in is kind of a combination of things. One is asking people to actually go through our process, which is a 7 or 8 or 9 week weekend every Saturday set of inexpensive workshops, combined with finding a free mentor or counselor that will work with you. And the reason why that's so powerful is because the workshops basically take you through everything that you need to know to prepare to actually submit a loan. The very first 2 or 3 workshops deal with how to build a marketing plan, how to build your operating plan, how to actually do your forecasting, how to actually start your business, what you need in startup money, how to forecast it out, and ultimately results in a finished business plan, which is usually what the banks and lenders are going to be looking for. If you kind of look at it from just the opposite side, let's say you were the lender and I was someone who's coming to you for a loan, you'd say to me, what is it that you're doing? Why would I want to give you money? Why? How do I think it's safe to give you money? I'm going to loan you money and I'm going to take the risk, but what is that risk? And you, as I have to then say back to the banker, well, I've done my research. I know who my competition is. I know what my forecast is going to be. I've done all the work necessary to show you that this is going to be a viable business, and therefore, I think you should loan me the money. So I would, suggest that you, look at these workshops and also sign up for a free mentor that will work with you all the way through the process until you actually get your business loan, and will help you actually through that. So that's my little pitch for SCORE. Let's see what the next question is. How do I apply for a loan? Anyone? I think I just answered that. What's included? What should I include in my loan package? Do I need a business plan? Yes. What are the steps involved in securing the loan? What type of collateral is needed? That's always a big question. And how much of my own money do I need invested in my business in order to get a loan? Anybody?
I'll give it a shot. Did I mention this is my first day on the job? Again, I think this is kind of a blur between startups and existing business, but the areas, and you may have gone through some of this with the seminars today, but how many people here have read the E-Myth? the book The E-Myth. It's a great book. And you know, a lot of us get into business or enter a business because we really are passionate about whatever it might be, making cupcakes or construction or whatever it might be. But the one aspect of the business that we're not necessarily prepared for all the time is the financial side of things. I mean, how fun are the numbers? They're just a necessary part of the business to give to the CPA every year. But they do tell a story, and they are a very important piece of the business. And we don't always look at numbers only. I mean, obviously, we spend a lot of time and pay attention to the management of a business, being prepared, like was mentioned before. But again, there are certain things that are very important when it comes to evaluating risk. You know, we've heard of the 5 C's of credit. I mean, cash flow. What does cash flow mean? I mean, at the end of the day, we have to make sure that a business is generating revenue enough to be able to support the existing loan request. I mean, you're going to have a strong cash flow and you're going to have weaker cash flow. It doesn't have to be perfect, but it is something that has to be there because we have to know going into a financing scenario that we know that we're going to be repaid back. So one of the most important things is cash flow. Another thing is we talked about the collateral piece. Collateral can be different things for the need. Equipment is a piece of collateral for equipment loan. Real estate loan is the collateral for real estate. For lines of credit, it is very often how a line of credit is established or viewed is based on your accounts receivable. I mean, a line of credit is something that bridges the gap in the operating cycle. So like was said before, you use the money, you pay it back. You've got accounts receivable, people pay you within 30, 45, 60 days, depending on the terms. Well, within that time frame, you still have to keep the lights on. So you lean on your line of credit, you get paid, you pay it down. So it looks like this during the course of a year. That is important. The credit issues or credit is important, or character, you know, making sure that there, you know, you've again, evaluating that we're going to get paid back. Now, does it have to be perfect? I think on the SBA side, the minimum score is, what, 640, or depending on the loan program. So it doesn't have to be perfect, but it is, you know, something that has to demonstrate that you're paying your bills. Trends are really important. With a business, again, there's a lot of different trends that go on with a business, whether it's revenue trends, whether it's profit trends, you know, your AR turn trends. These trends are important. They do tell a story, and it's important information to pay attention to. And then there's a debt to worth. How much debt does a business have relative to the equity or the net worth of a business? That's an important piece. Some of the things that have become more important these days that weren't as important in the past is the outside net worth. If you remember, maybe over the last few years, many of us, you know, used our house as an ATM machine. Equity was there, and if our business struggled and had a hard time, we'd go to our house and take some money out of our house and be able to keep things afloat. Well, now that values of homes have gone down, there's not that option's not there. So, you know, in the event that a business does have an economic downturn or things start to go in the wrong direction, does the owner have the wherewithal to support things until the business turns around? You know, those are the important pieces, and of course, what's also become more important is liquidity. Again, kind of ties into what I was saying about the net worth of the owners. Do you have the cash to be able to, you know, doesn't have to be a ton of cash. I mean, that's what you're looking for is money, but there is a partnership between banks and the borrower, and so some of your money is necessary to be able to kind of keep things going. So hopefully that kind of gives you an idea, and again, you may have already been, you know, the 5 C's of credit, but that's the important piece to break it down simply.
Just another, many of you may have heard the expression, the second line of defense. Well, that's what he was talking about, was that, you know, the banks are going to loan you money and they're going to use whatever your business is collateral, but they need a second line of defense just in case something goes wrong with it, and that's why they're asking for a certain amount of collateral that backs it up outside of, you know what your business is. Unfortunately, we're kind of running out of time, so I'm going to skip a few of these and go down to existing businesses. When I had my business, I actually used some of my collateral, some of my own parts of my business as collateral for a line of credit. I used my accounts receivable, my inventory, and actually some signed purchase orders that I actually had that I knew they were good bona fide business that I would get. So I ended up with something called a working capital line of credit. So I was wondering if someone wants to explain what that is for existing businesses.
A working capital line of credit is a short term, usually 12 to 18 months. And again, what it is you have to use it in a very smart way, because what it is short-term working capital. Your current assets are your cash, your accounts receivable, and inventory. And what you have to do is you have to convert the accounts receivable and your inventory in a cycle very quickly, hopefully within 90 days. And if you do that and you have a working capital line of credit, you should be able to get into that line of credit in 12 months. A working capital line of credit is not an amortized term loan. Like I went back and said prior, that a term loan is for long-term investment, long-term financing for equipment, capital, or if you're going to go out and buy a building, obviously that would be long-term. So working capital would be, by definition, is to finance your accounts receivable and finance the purchase of your inventory.
In my case, and this is a little dated because it's a few years ago, but I think they lent me 50% of my inventory, and that was valid, and 70% of my valid accounts receivable. So that's just a way to get some money while you're running your business. If you have, because that's an interesting asset that you own, and it's a good way to actually get some money. Anybody here looking at buying a business? A few people, so maybe someone could just ask, how do I finance the purchase of a brand new business? Anyone want to tackle that?
If an existing business, the bank will ask you to, and you have your right to ask for the tax returns of that business. You have to see how they're valuing their business. If they want $100,000 for that business, what are you getting for that? The term is usually goodwill, which means their client list. Well, that's great, but if their clients leave, you have no goodwill. So what you want to make sure you're buying is something that's tangible. Because if you come to the banker and say, oh, you need, I'm buying this business for $100,000 and I have $50,000, because this is what the bankers say, and for 40 years that I've been in banking, the bank doesn't want to have a bigger investment in your business than you do, because it is your business. We don't want to run your business for you. So typically when you go to a bank, they'll say, okay, do you have 50% of the purchase price, and what does it consist of? A bank will ask you for the financial statements of the business you're buying. And then they're going to ask you, what are you buying? If it's a medical practice and you're buying the patient load, that's or a law office, that's very tangible. If you're buying a retail business, that's a problem, because retail kind of goes back and forth, okay? So basically, that's what you need to know. What are you paying for? Because just because somebody wants $100,000 for their business, I had a guy that came in to me, he says, I want to buy this pool cleaning business, I want $1 million. And I said, good luck. I mean, what are you buying, you know? So he never called me back, you know. I was really offended by that. But anyway, that's you know, and I think my friends at any bank will tell you that the more you have in it, the more likely the bank will keep processing your loan. But it's very important to know that the bank, if you want to buy a business for $100,000, you come in for $60,000, the bank's going to say no, because then we're owners of the business. We're the biggest investor. We don't want to do that.
When I had my business, about 3 or 4 times a year, I'd go into the office with a coat and tie on, and everyone in the office said, "Oh, Bill must be going to the bank." And I said, "Yes, I'm actually going to see my partner." And I mean that affectionately. I had a wonderful relationship with our bank, and they were actually my partner in it. They helped me, you know, through some tough times when our business started to go down, and every business has its cycles, and helped me finance the growth of the business. And I actually have always looked to them as a partner with me. So, you know, you need to think about that. They're really not the enemy. They're actually someone that is that's there to help you, and they can help you by giving you good advice. Most of these people have said that they actually can counsel you and help you along. They'll ask you some questions that are kind of make you squirrel around in your seat, but they're valid questions, and you need to think about it, because basically they're on the hook with you taking the risk. So with that, I've run out of time. I'd like to thank Bill, David, and Ian, and Mr. Blank. Thank you very much.